You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
You wanted it, you got it. A radio program that helps teach you options trading inside and out. Basic to complex. This is Options Boot Camp. Remember, options involve risk and are not suitable for all investors. Now, let's get you into peak options trading shape. Here are your Options Boot Camp drill instructors, Mark Longo, Dan Passarelli, and John Critchley.
All right, everybody, that rockin' tune means it's time once again for Options Boot Camp, the program here on the old Options Insider Radio Network, where we break down all of the amazing things that you guys, as your basic retail stock traders, can do when you come into the options market and you start learning about these great products we have here called options. My name is Mark Longo from the OptionsInsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. And I'm very happy. We got a nice little treat here. This is the show I usually do with the black-hatted one, Mr. Dan Passarelli. Usually we do it remotely. We don't get to stare into the whites of each other's eyes. But that is not the case today, as we are in our newly renovated Options Insider studios here. And I'm pleased to say I am being joined by the black-hatted one himself in person. Mr. Passarelli, say hello to the kind people, sir.
Well, hello, kind people. It's good to be here in the newly renovated studio. This is fantastic, fabulous. Too bad there's no video. It's all pimped out here. Mark's got it going on.
Videos come in, and we're gonna. Yeah, it's still a work in progress. The first wave, I like to say, is finished. There's a lot more coming, including, as you mentioned, the video wave coming soon as well. We also got the live component going on as well. So if you want to learn about their options, you can follow us along over there at Mixlr. We tweet out the link. You can also find the link wherever we put out our Facebook stuff or on the website or anywhere else. Just grab the app MIXLR and you can follow along, chat along, do whatever you like to do, ask us questions. This is a great show to ask questions to, because that's pretty much all we're doing today is answering your questions. So without further ado, let's get right to it and get into the mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, everybody, like the man said, it's time for the mail call, the portion of the show where you guys get to take the reins and dictate what Dan and I are going to talk about here. For the rest of the program, we're going to do an all-listener extravaganza here on the boot camp today. Dan, are you ready? Have you buckled in for a boot camp extravaganza of all listener questions all the time? A palooza, if you will.
Oh, I'm ready, all right. Bring it on, baby. Bring it on.
Since we're talking listeners, let's kick things off. Since the last time you and I have sat down here, well, we didn't sit down at the time. It was virtual sit down on the program. We've added a new wrinkle to the Options Insider, namely our Options Question of the Week. We've been probing on the hot button topics of the day, if you will, sir, in the world of options. So I thought I'd get your opinion on some of these off the top of the show as we start. Some of these have already closed, so we know what our listeners are thinking. And I'll turn the screen here, listeners. I can see Dan, he wants to cheat. But I will turn the screen so he cannot see the results. And I will kind of peg him on his thoughts on these first. Then we'll kind of relay what you guys had to let us know. And our question this week, Dan, by the way, you guys can follow along if you're not already. Follow us on Twitter at Options. Just look for the Options Question of the Week. We tweet it out throughout the week. I think this week's question is still going for a couple more days. And our question this week, Dan, because it is still the tail end of earnings season, we kind of wanted to know. We said, how do you prefer to trade trade earnings announcements using options? We gave people 4 choices. We said, in long premium, short premium, I avoid earnings, or other, and they had to explain below. So I'll ask you, we still have about a day or so left in the poll. What do you think is winning right now, Mr. P?
Well, this is a tough one. I mean, if I were to answer what I think should be winning, it would be a different question. It would be a different answer than what I think is winning.
You only have 4 options we can give them at the end of the day, so we have to be concise.
Yeah, I'm going to say buying options is what people said.
Really? You think they lean to the light side? Interesting. If I had cynically thought, I probably would have said short premium. What I would hope they would say is that they avoid earnings altogether, that they listen to a show like this. And that actually, clearly, that's what they're doing. Now, here's the result so far, Mr. P. I'll turn it to you so you can see. A whopping 56% saying I avoid earnings altogether. So that kind of gave me a nice little warm fuzzy, sir, that people are actually listening to the show. 19% so far coming in on the light side, Dan. About only 15%. Maybe they don't want to admit it. I don't know. Maybe there could be some of that, too. They don't want to admit that they're just blasting out premium. I know from interacting with our audience, I think the percentage is a little bit more larger than that. And 10% coming in with some, random things they like to do, like verticals and stuff. But in general, that was that's the return there.
Yeah, well, this is something that's kind of near and dear to my heart. I mean, I'm pleasantly surprised to see that 56% of people said I avoid earnings. That used to be my advice to everyone. And if you're new to options and you're not like super experienced, you should avoid earnings, definitely, because that's the most wild card day of the quarter. When I was a young market maker, my risk manager, he would say, look, you're going home flat every day the day before earnings. You will not have a position going into earnings. At first I was like, oh, why? Here's when I can make some really good money. And then, of course, having gained experience, you go through a few earnings cycles, you're like, yeah, nobody knows what the heck's going to happen during earnings, It's just one big gamble. So I'm pleasantly surprised to see people saying I avoid earnings. When I do trade earnings, I do them a little differently, but I could go into a long soliloquy with that, so let's just move on.
Might be a good topic for a future show, how we like to approach earnings, or in the case of oftentimes, don't approach earnings. There are a lot of strategies you can do in the week before earnings, the week after. There's a lot of things you could do around earnings. Doesn't mean you have to trade through what I like to call, the Niagara Falls of the earnings event itself. All the rough waters, You don't have to go over the falls, listeners. You can ride it all the way down to the falls and get off and do a lot of other fun things. You don't have to ride it over. Since we're talking our polls really quick, we'll hit a couple others, Dan. These have already closed, so I know the results of these. This last week, of course, we've talked about this before on the show as well. We saw the launch of the 14th U.S. options exchange, ISE Mercury, that brings 3 to their total of exchanges alone, which is just a whopping number. So we asked, how many U.S. options exchanges do we need? And we asked them, hey, is 14, gave them the choices. 14 is perfect. The more the merrier, make it stop, or other, and explain below. What do you think won, Dan, of those 3 choices, or 4 choices, really?
Man, this is another one of these where I have a strong opinion on, and what I think did win and what I think should win is probably different. I'm going to say people said, not my answer, but I'm going to say people said the more the merrier.
Really? Wow. You lean towards the optimistic, the better angels of our nature. I lean the cynical side, which is funny for the black-hatted one. I lean cynical. I was hoping personally they would say make it stop, and they did. A resounding 62%, Dan, saying make it stop. No more exchanges, please. For the love of God, no more. It's hard to argue with that one, really. It's so many, and it's so de minimis, the value they're adding versus the amount of risk that they're actually bringing to the equation, and the cost. If you're still one of the few firms who's actively trading and market making in this space, the cost of adding another venue, the risk of... And at the end of the day, too, there's only so many firms to produce liquidity. If you add another exchange, guess what? It's just coming from somewhere else, that liquidity they're putting there, So they're going to reduce their size elsewhere to display any liquidity there. It's just... It adds nothing. So, yeah, 5% said 14 is perfect. 29%, almost 30. I'm guessing these might be the pros, the industry officials in our audience who are saying, hey, we want more exchanges.
Yeah, right.
They were saying, so who else is coming in cheering for more exchanges? And then 62% saying make it stop, and 4% saying other. And then we got one more here.
Yeah, before you go on, like, the whole purpose of an exchange, think back through history, why is there an exchange? There's an exchange so that everyone could get together in one place to provide an open, totally transparent, totally visible. You can see what everybody's doing. Nobody has an advantage. That's why an exchange was originally created. They're supposed to be one. I don't know, but now the market's fragmented, and that I think the SEC thought it was a brilliant idea, but it promotes its own problems. That's for sure.
Yeah, I could see maybe. I mean, I was there obviously as you were, and the whole multiple listing fray happened, and there was a lot of pushback against it. Then I could see an argument for like a core base of like 3 to 4. So maybe you spread it out in case one has a glitch or something. There's certainly an argument to be made for multiple venues just to spread out the risk. But after a certain level, whatever that number is, 3, 4, whatever, it starts to become de minimis after that point, where you're like, okay, now you're just adding risk instead of reducing risk by adding these new venues. And so I'm glad to see that our listeners, the pros aside, resoundingly, I'm guessing all the retail came in. If I had to guess, that's pretty much how our audience breaks down, about 2/3 retail and about 1/3 or so active pro kind of in the space. And that's kind of how that vote broke down. So I'm guessing that's not a coincidence. And we kicked it off a couple of weeks ago that we had this idea to do this question of the week. We kicked it off at the time, because this is earnings season, Dan. You and I have debated this topic before a little bit on this show. It's earnings season, and one question we get almost above all others during earnings season is this. It's, hey, I bought whatever, a vertical. I bought a straddle, something, an XYZ name. It went out after earnings. The thing moved 40 handles after hours, and then the next day when it opened, it was unched, and I couldn't get any of that. Why the hell can't I trade options after hours, or some derivation therein? We get that question all the time in the 3 months of earnings season or close to it, So we thought we'd kick it off in the heart of earnings season. This was like Google week when we wrote this, and we said, should options trade after hours? We said, heck yes, or only in major names. Now, some people want to have like a limited kind of pilot time to make it, so maybe a more limited pilot version. And then no, because it's poor liquidity, or no for some other reason. So I'm curious, Dan, how do you think this one broke down amongst our listeners?
I've got the same philosophical answer for
your head and your heart are pulling you in two different directions, sir.
Yeah. Here's what I think people said, and this is not my answer. I think people said that they want after-hours trading.
They resoundingly did. They said, heck yes, 53%, 15% saying only in major names. Again, that was probably the pros floating around our audience there. 15% saying no for poor liquidity. And I knew there's other reasons why you might say no to this too. So I said no for some other reasons. And some people put in that they trade other products like futures options that already have after hours. They don't need in equities and stuff like that. So that was kind of the rub there in terms of things going on. And in terms of that, so that's our listener poll rundown there, sir. And we're getting notes from people who are monitoring our live stream to make sure everything's working. By the way, if you're in the chat room, you have some questions, fire along. We don't mind hearing from you guys. We'll take some live questions. It's kind of the fun. And it's still kind of a new wrinkle we're adding to the network here, Dan, of the live. But people seem to be responding to it. They like it. And I think, particularly for this show, once we start getting this into a regular rotation, at a certain time of the month or week, people can know to tune in. It'll be really fun to have people kind of tuning in and firing off live questions. I know sometimes they can derail you with all the questions, but that's kind of the fun. It's kind of like doing a little bit of live theater, something I know you like. You're a bit of a performer yourself. Listeners, if you're ever in the Chicago area, you got to come see Dan's band. They rock the house. Dan's been known even to sing a little bit or two, which is both fun and terrifying at the same time. I've been there, listeners. I cleaned out the merch deck for his band, so I have all the items. If you want to buy some stuff on eBay, I've got it for a reasonable rates. All right. Moving on from Dan's band and from your polls. I'd love to hear from you guys. That's why we want to feature you guys on the show today. Let's kick things off with a question. We get this relatively frequently, Dan. This one we picked comes in from Alfy. He says, or I should say he asks, is it possible to be a day trader using options, or do you have to take a longer term view? It seems like this is common refrain. There's people who come to this. Obviously, people come to options from a wide variety of backgrounds. Some are active stock traders. Some come from futures or other products where they're kind of geared to a more short-term kind of mindset. They're getting in, getting out, scalping a little bit intraday. And then they try to take that mindset and they try to apply it to options. And they're kind of overwhelmed, for a variety of reasons. We're always talking about the Greeks and things here on this show, and they have to learn all that stuff. And now they're looking at verticals. If you want to trade a vertical, guess what? You probably need a little bit of time for that one to play out. You need to have the underlying move. You have to have some theta work in your favor, vol, a bunch of other things. Kind of hard to do that intraday. So maybe that's something we should do on the show too. Maybe we should start trying to feature a few more, short duration type trades people can do, because this is a popular question. I'm sure you've gotten this a lot, Dan. People come to you for training and mentoring. They say, hey, I want to trade options intraday. I don't want to just write a quarterly covered call in my IRA and call it a day. So what do you say to your clients, to your mentees when they come and they say, hey, I want to get in, I want to rock and roll, I want to sling all day long with my options?
Yeah, I mean, the question is it possible to be a day trader using options? Sure. Is it possible to swim across the Atlantic Ocean? Yeah, I mean, I guess it's possible. I mean, I don't think anybody's done it. I mean, you think you'd have a hard time. I mean, anything is possible, but I could not imagine a harder way to try and make money trading options. And I have never in my life, and I've been in options for, I don't know, 23 years or something now. I've never met anybody who has made a sustainable living out of day trading options. I mean, there is so much working against you. Every once in a while, I find somebody who tells me they do, but then when you start questioning them further, you find out they're, not being quite truthful.
Those like the guys you used to always meet on the pit who would easily and readily tell you how much money they were making.
Right.
And you always knew that they were full of it.
Yeah. Anybody, it's kind of like an inside thing here. Mark knows, like anybody on the trading floor, if you ever said, oh, hey, you making money? Anybody who was making money always said, oh, no, things are kind of rough, because you didn't want them to come into your pit. You wanted to keep the money for yourself. But anyway, back to the question here. It is there's so many things working against you day trading options. I mean, first of all, options have a delta. So, if you buy 100 shares of a stock and the stock goes up $1, you make $1. But options move less than the underlying stock. So if the stock goes up $1, you're only making, 50 cents or whatever it is the delta is. So you've got that working against you. And then you've got all the, when you're day trading, you're only trading direction, but then you've got volatility to worry about. So that's basically like a wild card risk, that doesn't help you in any way. And then the biggest thing though is the bid-ask spread. I mean, if you're trading $100 stock and the bid-ask spread's a penny wide, okay, great. So, you give up to the market in slippage 0.01%. Okay, it's not really the end of the world. But that stock probably has options on it that are 3 cents wide, and, you're buying a $3 or a $2 call, and the options are 3 cents wide. I mean, all of a sudden that starts to make up a pretty big percent. It bites into your profits. So, yeah, I mean, it's a terrible idea to try and day trade options.
Yeah, you're right. Even if you were going to consider it, because all the things you just mentioned, spread and everything else like that, you're kind of limiting yourself to a very small pool of classes and names and even months and strikes you can even start to choose from. You're talking like, at the money SPY and Qs and Apples and a few others that are even tight enough to even start considering that. You have to be a couple of cents wide or a penny wide at the most, So you're talking, you can't go out and do your 6 month out, 20% out of the money puts in a Best Buy. This is not going to happen, So yeah, you're already talking about a very finite chunk of the options verse you can even think about playing with. So hopefully you like trading those because that's all you got. And then you're right. Then a lot of the strategies we're talking about here, they just require something to happen in order for those strategies to really pay off. A sharp move in the underlying, time decay to happen, maybe all of the above. And the chances of that happening intraday are just remote. So yeah, it's that said, there are a lot of the focus of trading has moved in the shorter term. The advent of weeklies has really, knocked it out of the park. Pretty much I'd say, I don't know, at least a third of our audience is probably actively trading in the weeklies right now. So that's shorter duration than it used to be. It used to be all monthly. So there's something to be said for that. And now, of course, with the SIBO announcing, I kind of joke, but I take some credit for this. I was pestering them about adding dailies, and they said they're going to start doing essentially additional weeklies. So now they have obviously the regular weeklies expiring at the end of the week. They're going to add what they're calling a Wednesday weekly. So that'll effectively, down the road, there's going to be a Thursday weekly and a Tuesday, and it's going to be so effectively you're going to have daily expiring options at that point. So that's kind of getting there at that point where you have these options that are going off every day. So who knows? Maybe in that environment, maybe you might see things more conducive to that, but still, all the things we just kind of mentioned, all the caveats we just mentioned still apply in terms of you still need something good to happen in that time frame in order for those trades to really make sense. And I don't know. I see you shaking your head. That's why I like doing the show live. Dan's shaking his head. So I'm guessing the notion of Wednesday weeklies and weeklies dailies all week now is not really sitting well with you, Dan.
No, you know what? See, this is another one of the problems of having, 117 exchanges or whatever it is we have now. I mean, on the one hand, competition is good, but on the other hand, like all the exchanges are just getting choked out. It's so difficult for them to make money that they have to have their financial engineers come up with these crazy, wacky ideas, like hey, well, let's invent a new product. Like, the fact is, options, pure options, just buying calls and buying puts, is the most amazing financial vehicle of the last, probably ever invented. Surely the last, 50 years. But I mean, just the ability to protect you, just the ability to trade regular old calls and puts is fantastic. You start adding all these other things. I mean, you're getting to the point where I don't feel like it benefit. It's not that I don't think we need. I mean, I know I don't think we need them, but I just think that it just starts getting confusing, and the benefit you're trying to create ends up being somewhat of a detriment.
And when I say jokingly that I pushed for them, I was actually relaying. We get a lot of questions about that, as you might imagine. When are they going to add dailies? So I kind of just dumped a bunch of those questions on the folks over there at the SIBO. And I said, hey, you guys answer them.
Yeah.
And they did with a new product. But, it's interesting. Yeah, and I think the way they're rolling it out, if you're going to do weeklies, or dailies, I should say, makes sense. You're just adding more weeklies. You're adding to the strip. So maybe for some reason you don't want a product that has a full week's worth of decay and everything else in it. You want just a day or two because you're looking at a specific event like an earning, which is what weeklies were intended to be. They were intended to be tools to buy, to hedge around earnings, things like that. They haven't worked out that way. They've worked out as a tool for everyone in the mother to sell. But they were intended to be risk mitigating. So maybe, who knows? Maybe in this case we'll see, when the advent of more daily / weeklies, maybe that will lead to more nuanced use cases of them. I don't know. But cynic in me says no, but you never know. Moving on to the next question. This one actually is one we answered on one of our other shows, Dan, but I thought it was informative to talk about it here as well, because it's kind of an interesting thought question and the way you kind of approach options. This one comes from Alex. He asked us actually on our Facebook page a pretty detailed question. It was during the LinkedIn earnings, and a whole bunch of stuff was going off out there, and it was a crazy time. It was very volatile. And he asked about shorting. He wanted to short a 1-year 25 delta put on LinkedIn. He had a bunch of stuff. And I went back and forth with him, asking him some questions, why he was looking at that versus these. And it kind of came down to kind of talking about that's why I want to talk about it in this show, the relative merits of selling a very, very far out contract like that, a 1-year contract, versus the merits, as we talked about on this show, and what we were just talking about, selling something a lot closer to the money, closer to expiration, because, you wrote the book on the Greeks. Obviously, you had a lot of stuff devoted to theta and time decay. And, we all know that theta portion gets near exponential the closer you get to expiration. So logic would dictate that you want to migrate a lot of your liquidity on the short side closer rather than farther out for all those reasons. And we just saw some interesting studies coming out of the SIBO and a few others comparing, we talked about on the show last time, writing weekly options on, I think it was the put right index, which was the at-the-money SPX. They just compared that, doing it weekly versus monthly, and see what the difference was. And the difference was hugely beneficial to write the weekly. And they just did it, this came out this week actually, with their version on the Russell. Same results. The weekly put right on the Russell versus the monthly dramatically outperformed from a premium harvesting annual amount of aggregate premium. They'd have to look at the underlying, see how the underlying held up and things like that. But definitely from a premium harvesting position, it was demonstrably better. And so all the data we have, really leans towards, you want to lean towards the short. So the conversation I had with him, and what I want to put to you as well is, outside of some weird aberrations, and LinkedIn, when he sent it, he has got a nice little chart here, Dan, I'll put it for you. He was really very detailed in his thought process with this. I'll skip the whole, there's a very long question. Look, he threw this chart in here of the term structure of LinkedIn. I love our listeners. They get really deep. Yeah. And he's got the term, he's like, look, isn't this attractive? Because he's saying it's deep out here. And so I could certainly, if he likes it, he's happy with it, I'm cool with him. But my point was still, unless there's some crazy aberration in the term structure, I don't see a lot of reason for going that far out to write a put, for a lot of reasons. You got to sit on it for a year. You can't really adjust it. The strike you select now and a year from now, the relevancy, who knows if that strike's even going to be relevant. If you can write narrower term, not only are you collecting more money throughout that same time period, but you can adjust more frequently. So as the underlying moves, you sell what's at the money now. A month from now, who knows, let alone a year from now, who knows what the at the money is going to be. So you can keep writing relatively the same distance out of the money calls or puts, whatever you're doing, and keep doing that over time, and keep having that same delta, that same approximate, degree of near the moneyness versus this one strike and you're done. So there's a lot of reasons against it. I'm curious for you, what do you counsel people who come into market taker? I'm guessing I know how you lean, but I don't want to put words in your mouth. And then also, if you can think of some scenarios, like I was walking them through some scenarios why this might be interesting. What are some scenarios where you would consider leaping out that far to write premium versus just doing it, closer to expiration?
I'd be hard pressed to really think of a scenario where I would write a 12-month option. I mean, I couldn't really imagine a scenario where that would be more advantageous than writing 12 individual 1-month options. And I'm looking at the chart, and Alex, I'm sure you can appreciate we surely don't have time to read through this whole thing.
Read them every data point, starting with February of 2013 and moving on, and you could see all the peaks and troughs of the term structure, sir, and do it very well and articulately so they can understand in their mind.
Right. But, I'm looking at this chart, and I suspect that it's bad data. I mean, I think volatility, which I think is where this chart is from, ultimately anyway, has really good data, but, I mean, nothing's perfect. I mean, one bad number can throw things really way off, and it just seems pretty close to impossible that this could be accurate because, as many of you probably know, implied volatility tends to change more in the shorter term expirations. Like if implied volatility rises, it might rise, 10 points in the weeklies and 7 points in the week after that. And then, by the time you get to the leaps, if it changes 1 point, it's a freaking miracle. It just seems almost impossible that this thing could have jumped up 170 points in a day. So I don't know, especially the further out in time you go, like, data can be kind of bad because, the bid-ask spreads tend to be really wide with leaps, and if somebody puts in an order right before the close or something like that, maybe to buy, right underneath the bid, like they're trying to middle the market, that's going to throw things off, although not 170 points. So I don't know. Anyway, bottom line, I'm kind of rambling a little bit. I speculate that the data in this chart you showed me might be bad, A, and B, I mean, look at theta. I mean, the proof is in the pudding. If theta is higher in the 1-month options, then it's obviously way better to sell a month put, and then the next month roll to another month put, the next month roll another month put. You'll probably make twice as much money. I mean, I don't know. We have to look at the numbers on a case-by-case basis. But you'll probably make twice as much doing it that way than selling a 1-month option.
Yeah, I mentioned that to him, too, in this chart he sent us. There's a clear market spike in the near term as well, so obviously it doesn't carry out. There's a bit of a trough there in the middle. But, you could capture some of that in the near term and then try to find more aggressive strikes down the way. Either way, he was happy with his 1-year put, so I said, okay, if you're happy with it, that's what you want. We're not here to dissuade you. We're just, it's an interesting thought experiment of, like, why you would approach things. And, again, I'm glad you're here in person, Dan, because we have a lot of visuals for today's show that I want to show. Again, our listeners are great with the visuals. There's one we got in, again, earnings season, a fun time. Another one to talk about on the show is kind of interesting. This one comes from Michael. I think he was buying, I'm guessing he was buying these puts. He says, hey, the $15 put, 15 handle put in Twitter drops off the map, yet the premium still has been declining. Can you explain? He put a little, I love the visuals. If you guys have visuals, send them along. They make it more fun. Here he included a quote from his Twitter showing that indeed, when he means drops off the map, this was back about a week or two ago, I think. The stock had dropped $1 off the op stock was trading about 14.5, so south of the 15 handle, which is what he's talking about. Yet he sent us a quote here for the 15 handle put that it was off 50 cents nearly, or about 30% to $1.13. He's like, how can this happen? And Dan, this is kind of the flip side. I mentioned the after hours question. We get that a lot during earnings, but if there's still a number one question we get overall, it's the converse of this. It's usually people write in saying, I bought a call going into earnings or whatever, and the underlying rallied and my call lost money or didn't make as much as you thought. How is that possible? This is kind of the flip side of that, but it's the same conversation. This was going through earnings, and our friend here, this is kind of what we mean about riding the Niagara Falls that is the earnings event. I've said before on this program, when it comes to volatility, earnings is kind of like volatility is like a balloon around earnings. It keeps inflating, and once the event happens, that balloon's going to pop. And unless there's something dramatic going on in the underlying to offset it, a dramatic move, a dramatic surprise in one direction or the other, that balloon's going to pop. And if you're a long premium, you're left holding essentially no longer a full balloon, Dan, but a very the scattered pieces of a balloon in your hands, and that's kind of exactly what happened here. The earnings of this is I believe the morning after the earnings event, Dan. So the volatility imploded, which is kind of what you expected. This put lost almost a third of its value, even though the underlying moved its way. Imagine if the underlying didn't move, listeners. This thing would have gone very close to zero very quickly. So Dan, I'm sure this is kind of a scenario you probably counsel your mentees against a lot. This is one of the reasons why we say don't trade earnings if you don't have to, because this kind of stuff can happen. It's a dangerous thing to have. What do you say to your listeners, or I'm assuming your listeners, your mentees, your clients, when this kind of stuff inevitably does happen to them? This is kind of the post-earnings effect, the vol meltdown. I'm sure you've gotten this question a lot as well. What do you say to people who have these kind of similar, how can this possibly happen to them, Dan?
Yeah, I mean, it's a great lesson in making sure that you're paying attention to all the things that affect the value of your option, and knowing that things don't always play out the way they're logically supposed to play out. Implied volatility tends to get crushed right after earnings. Excuse me, and sometimes it can get crushed pretty darn hard, in some ways, it seems counterlogical, like, well, wait a minute, if the stock goes down, isn't volatility supposed to go up? No, that's not always the case. I mean, even in normal market conditions, that happens 80% of the time. But, following earnings, I mean, once the stock drops, then the move is in. The thing that people were hedging against has happened, and they either made money on their puts and the hedge worked, or they lost money on their puts and they don't want to lose any more via time decay. So, I mean, that's where the crush after earnings comes from. Even if there's a big move, people sell out their options and implied volatility falls. So, you really have to look 3 moves ahead, like a chess game when trading options, and think, realize A, what all the factors are that affect the value of your option, and B, what influences go into each of those things: direction, time, and volatility.
Yeah, I mean, in this case, look at this thing moved his way. These puts are 60 cents plus in the money now. This is a 15-handle put. The stock was at $14.37 when he sent us this screen grab here, and these things still lost a third of their value. Imagine if the stock hadn't gone his way, how much these things would have been crushed. So that goes to show you, listeners, just how much juice there is in these names. If these other things you're looking at, volatility percentages and everything else, if that kind of just hurts your brain, you can't really make sense of what an 80 or 120 vol really is. This is it in stark living color here, the impact of volatility.
And you know what? Like, I mean, this kind of stuff happens all the time. And I forget this questioner's name again. It's
Michael. Yes, Michael.
Michael. Yeah, good. Yeah, I mean, at least it sounds like you're experienced enough to realize, like, yeah, this is one of these things that happens, and it happens sometimes, and can you help me understand the explanation? You're savvy enough to have that intellectual curiosity to make you a better trader. Frankly, half the time people just come to me and they say, oh, well, there's something fishy about options. You guys are ripping us off. Like it's, I don't know who's, like, it couldn't possibly be their fault because they don't understand how, volatility works and that kind of thing. They blame somebody else. But, this, for everybody listening, this is a really, really important lesson here. Just to recap, bought puts before earnings, stock went down, put value went down. Seems counterlogical, but the volatility crush was bigger. The negative impact on the put price because of volatility was bigger than the positive impact on the put price because of delta. And it's a perfectly normal phenomenon, and sort of forecasting implied volatility beforehand and realizing that there's a crush and sort of estimating, well, how much am I likely to lose on volatility after earnings versus how big of a move am I hedging against or speculating on via delta. You're going to have way better results going forward in the future when you weigh those two options against each other, or those two factors against each other.
All right, I just want to make a mention to people listening in the chat room. I do believe in the live chat, you have to have a a Mixler account which is free to post questions through it. So if you don't want to go through the hassle, you don't have one for whatever reason, you can still hit us up via the normal means, of course, Twitter or questions at the Options Insider. Probably Twitter's the best when we're doing it live because we have the best chance of seeing that during the show. Someone will catch that and bring it to our attention. Email, maybe not by the time the show's done. But yeah, we like to get a few live guys on here too, even though we have a bunch of people who've already written in. I want to make sure some of you live guys get your time on the show here. So don't be shy as we move on to another one here. This comes from Futures MD. I'm guessing, Dan, we're going to be getting a lot of these types of questions over the next 6 months. He wants to know, is there a directional option strategy that we'd suggest for someone who wants to play the 2016 election? So we're getting a lot of these already. Wait till October. We're going to be overwhelmed with these questions, Dan. But yeah, here we are now in the end of February as we're recording this here, listeners. Still very early in the U.S. presidential election cycle. Just finished, I believe, Nevada was the most recent primaries. It's a crazy season we have here, all leading up into the big. We don't even know who the nominees are, quite frankly, yet. So predicting a directional strategy is a bit hard. And then also there's a lot of this comes down to who the nominees are, how the market perceives them. Is there some sort of, crazy disparate view of this? Is one guy clearly the front runner going in which case the market's probably going to bake in that well in advance, not really a lot of chance to trade that? Is it a close, contentious race with two people? Let's say, for the extreme examples here, let's say if there was Trump on one hand and like Bernie Sanders on the other, and they were neck and neck going into the election day. Those are two diametrically opposite viewpoints of the economy, you could say. I could see a little bit of volatility resulting as something like that. So versus, let's say, I don't know who it is, Hillary and some other person who's just far off the map, no chance of beating her, then the market's going to bake that in well in advance. So there's a lot of ways this could still shake out that would affect this, which is kind of hard to say, hey, go buy a vertical now in November or something like that, But still, talk a little bit about what you think of with elections. I was down there on the floor you might have already been done by then, but for the whole Bush-Gore brouhaha, which went on for a month, which was some of the craziest election vol I've ever seen in my life. I hope to never see anything like that again. That's probably the ultimate outlier in terms of electoral vol. I think most of these are kind of baked in going in to the event. But what are some of your thoughts about elections and their impact on volatility, as well as some ways you might want to play it?
I don't get too political, but the front runners that it's shaping up in both parties here are probably the best strategies to move to frickin' Canada.
Oh, here we go. Letters to Dan at markettaker.com.
Yeah. Like I said, I don't talk politics, but
let's stick to the Greeks and to the options. It's much less frustrating that way, sir.
Fair enough. Yeah. So the thing is, the election is still somewhat of a ways off. Like if I want to go to the opening day Cubs game, I'm not going to go and sit in a seat there today and just wait there until the opening pitch. You can't really trade it yet. So you've got sort of some time. I mean, yes, can you put on long-term options, but so much is likely to happen between now and then that's unrelated to the election. You've just got all these wild card risks, and you're trading a whole bunch of things that you're not planning on trading. So sit tight. I'm glad you're thinking about it now so that you can kind of come up with a plan. But, it kind of depends on once we know who the two or potentially more, I guess, individuals who are going to be the actual presidential candidates, who they are, what your opinion is on the potential outcomes there. I mean, largely, whatever strategy you select is going to be extremely heavily rooted in volatility. You will really have to pay very, very close attention to historical and implied volatility, making sure that you're taking advantage of that, buying if it's underpriced, selling if it's overpriced. I mean, just classic fundamentals. At this point, all I can really do to help you is just to kind of give you some of these general concepts because we're so far away from it. But, watch volatility first, and then you can sort of plan your directional guess around that.
Yeah, we'll have more, obviously, grist for the mill as this gets closer. Right now, you're right. It's kind of like saying, how would you play for, Amazon or Apple earnings in Q4? We got Q2 and Q3 to get through first. There's a lot to get to before you get down there. Speaking of which, we had one of our first live questions coming in here on the show today. This one coming in from Roaming TK. I like that. He writes, hey, I'm listening to your February 25th broadcast. On CNBC, some traders watch for, quote, unusual options activity and then jump in on the trade. That seems an odd trading strategy to me. What are your thoughts? Well, we've talked about unusual activity before. We actually mine a lot of unusual activity data at the Options Insider. In fact, we were some of the earliest to really kind of get the ball rolling with that about 9+ years ago when we started the site. We started looking into this data and putting it out there and making it widely available to people pretty much for free. Like, hey, there's interesting stuff going on here. You may want to take a look at this. We weren't selling a service or anything. We just wanted to get that data out there. Now it's much more widely accepted that UA is an interesting thing. We had the first a couple of years ago. I still have the poster over there, Dan. We're going to hang it up in the thing. We had the first that I know of unusual activity conference, a conference devoted entirely to, you were there, Dan. You spoke at it. Usual activity conference. So we have some skin in this game. We talked about studies there about how UA is still, from an options perspective, is still the most reliable indicator when it comes to different things. And also, the weird thing about it is all the studies compared, known events like earnings and things like that and crop reports versus surprise events, unknown events like, surprise earnings announcements or surprise downgrades. And the options activity, the increase in the movement was the same, sometimes more on the unknown one, showing people in the options market do know a lot of this kind of stuff. So if you're looking for an indicator, options activity is one of the better ones. That said, there is a lot of nuance involved. That's what we devote a lot of time to. We had a daily show on our network, parsing unusual activity. We do it a lot on the Odd Block, which is, of course, a segment on our popular option block program. We do a lot of time showing you exactly how we break that down. It's not a simple science saying, hey, someone bought calls, 10% out of the money calls in Apple, therefore they want the stock to rally. It's not as simple as that. You have to look at the open interest. The first thing you can see, maybe they're closing, in which case it's a totally different story than what you thought it was. Also, what's going on with the underlying. You have to dig around, see if they're hedging it. If they're doing that delta neutral, guess what? Different trade than if they just came out and bought calls. Also, the implied volatility on that strike. What's going on. That can help you ferret out what the actual intent of the person. No one's going to come out and say, hey, I bought these calls and that is because of X, because I know this information. You have to kind of ferret that out and intuit that yourself, and that's kind of the challenge. So we walk you through a lot of that. And all that's to say, even when we find a trade that we think has some grist to the mill to it, Dan, we think, hey, this guy may be onto something. He's done this before in this name and it's worked out well, or this looks pretty interesting given the setup here. This may have some grist to the mill to it. We never, any time do we ever say, okay, this guy bought 10,000, 10% of the money calls. We want you to come in and be the 10,000 and first on that strike. That's the worst way to go, because now this guy, by definition, he's done something unusual. So he's created a distortion in the volatility in this name. He's bid up, in this case, in our hypothetical example, he's bid up the call wing, made those calls more expensive. So if you're coming in now and buying the 10,000 and first call after this guy, guess what? You're paying all the inflated volatility premium he just built into that contract and everything else. So if we point out an alert, you see it somewhere else, and you do your homework on the name, you think this is a meaningful indicator, we always counsel to take a more nuanced approach to that. So in that case, most of these trades we're looking at are buying out of the money calls. So we always say, you know what, take advantage of the distortion that guy created and sell that strike. So maybe instead of buying the same one he did, if you agree with this guy, you buy a meteor option, maybe an at-the-money contract. It may cost you a little more, but then you turn around and sell the strike that this guy just bid up. And so now you're taking advantage of the distortion he created to sell it. Now you're legging into a vertical spread in this case at a level that's far more attractive than you can get otherwise. So you're taking advantage. You still have the same outlook this guy does. You're putting on a spread that has a higher probability of making money for you, and you're taking advantage of getting it at a very reduced price. So that's the way we like to utilize unusual activity. But once you've done all the homework, you think this is an indicator that's of value, you have to put it on in a nuanced fashion. If you just blindly follow them like a lemming, you're going to go off the cliff like the rest of everybody else. Dan, I can see you got some thoughts on this issue as well. What do you have to say to our friend here, Roaming TK?
Yeah, this is an issue. Mark and I have pretty similar backgrounds, as I think all you guys know. We're both market makers down on the SIBO trading floor for a long time. And consequently, our views are almost always the same on everything. Here's one where...
Except in music, sir. I can't stand your music. I'm just kidding. I like your band.
Here's one where I think we probably actually do have a lot of commonalities, but I'm a little bit less of of a fan of.
That's why I wanted to toss this because I know you're not as big on the UA stuff. So now we get the point counterpoint. Jane, you ignorant slut.
Yeah, right, exactly, right. I counsel my students, most of my students, to, especially the newer ones, don't even look at unusual activity because you're probably going to end up getting tricked. You know, Mark pointed out some really important things, you know, that, okay, good, 10,000 contracts, 10,000 calls trade, great. What does that mean? Well, you know, newbie traders wet behind the ears, their gut instinct says, oh, that means the stock is going up because that's where, you know, the insider is buying all these calls. That means the stock's going up. And no, because like Mark said, you don't know if they're buying or selling. You don't know if they're opening or closing. You don't know if they're hedging. And you know, Mark pointed out all these important, you don't know if it's part of a spread, but you know the one thing you really don't know is you don't know if they're going to be right. People make these assumptions that anybody who's, you know, slinging 10,000 contracts, they know something. They don't know anything more than you or me. They don't have any information that's not available to you or me. You know, could their feeds be a little faster? Could their news sources be a little bit more elaborate? Maybe they paid, you know, $2,000 a month or whatever for a Bloomberg terminal. It's still all information that's available to anyone. So you can't make the assumption that they even know anything. I mean, they could be wrong. So, you know, the whole thing about tricking yourself into thinking that you're seeing something without really looking at all the information, and then that final leap of, you know, blindly assuming that this person's going to be right, so you should jump on their coattails. To me, it's not worth it. To me, do your own homework, do your own work, and you know, you can. If you're a smart trader and you put all the work in, I think you can outperform a lot of the professionals out there.
You know, it's funny, all that said, and I do agree with you. I think it is a specialized use case that really, you can't just go out and blindly do it. And our mantra on the network from the beginning, even though we kind of helped pioneer a lot of this unusual activity stuff, has always been from the beginning, size money does not equal smart money. Mm-hmm. That's kind of always the perception that, oh, someone can afford to buy 10,000 calls, they have more access to information to me, this is smart money. We profile, I lost track of how many we profiled on the site and then even on the shows. We just did 500 option block episode last week, so we've done at least 500 odd block segments with 3 each. You're talking at least 1,500 names just on that show, plus others. So I've lost track. I have to say, roughly, my rough estimate, 70 to 80% of those trades we profiled are losers. You know, these people, just because they're doing size, are not at all indicative that they know something. So you have to, that's why I say you have to really do your homework. Don't just see someone blabbing on any outlet. I don't care what it is, CNBC, newsletter, what have you. Hey, people buying calls, that means you got to die. That's a flag. That's certainly a flag to you to say, hey, I should look into this more. And totally. that's value there. But don't just dive in on that. And if you do the homework, you decide it's of value, then do it the nuanced way that I said, not just following it, and you have a much better chance of, even if the guy isn't as right as he thinks he is, or even if he's wrong, you still have a better chance of doing it well yourself.
And you know what else happens, too, sometimes is, you know, you even see this with alerts like, you know, I know exactly what this trader is doing and why, you know, and some professional trader goes and buys 1,000 of these calls. He tells you on CNBC or some business, you know, here's what I'm doing and why. And then, you know, you follow, and then a week later, like, you lost money on it. And what you don't realize is that he saw an opportunity to get out. It's not his responsibility to tell you when to get out. You know, he's not your, you know, whatever. He doesn't owe you that, you know, but he saw an opportunity to get out. He probably made money, but if you didn't have a trading plan, your own trading plan, you could lose money even on a trade that, you know, somebody else made money on if you don't time it right and follow through with the sound plan.
All right, we're coming up against it. We did start a little bit late, though, Dan, so we can go a few extra minutes here before you and I have to hop off. I'll give you the choice since you're in the hot seat here today. We got a bunch of ones, people who have written in, but we got people chiming in with live. TK here has got another one. Should we give him another chance to go another go-around at the windmill here? It's a quick one.
Oh, why not?
All right, go ahead. We'll do it. Dan decided you get another live one. There you go, listeners. This is what you get for listening live. The live questions bumped to the front of the queue. I need to see what this one is now. It is, oh, here we go. If one does not, this gets back to what we were talking about at the top of the show here, Dan. If one does not trade around earnings, don't we still need some catalyst to get a meaningful move in the underlying price? Yeah, you usually do. That's what we were saying before. That's why these option strategies that we were talking about, they require something to occur usually. Unless you're short premium, then you want nothing. then you want nothing to occur. But yeah, generally you do need something, if you're going long premium particularly, to juice that trade into making money for you.
Yeah, I mean, to answer your question as it's written, yes, you do need a catalyst to get a meaningful move in the underlying price. But to me, that's not the valid question, because you don't need a meaningful move in the underlying price to make money with options. Most of the traders that I know who have longevity and have made money for, a decade consistently month after month, they're the ones who are trading and making money on stocks that don't move. They're the ones who are using income generating strategies, things like iron condors and time spreads and, that kind of thing that makes money when there is not a meaningful move. When there is a meaningful move, that's when they run into trouble. And that's the beauty of options. You don't need a meaningful move. I mean, if you get one and you're a directional momentum person, great. If not, great.
Yeah, how many times did you, I used to see this, I used to love playing this game, walking around on the floor back when Expiration Friday meant something, and it was once a month. Yeah. You could walk around to any given pit and just look, and the guys who were kind of calm, sitting there, you could tell they were long premium or had flattened out, and the guys who were popping the tums and sweating, they were the guys who were riding it all the way to the end, short premium, and that's the scenario where you don't want anything to happen at all. You want your premium to erode away as fast as possible without any sort of turbulence. So that's kind of, that's what you're referring to. People who want to harvest premium, they're the other side of that coin. They want nothing to happen. Interesting fact, you mentioned iron condors. When we were on the Option Block show last week, we had our old buddy Alex Jacobson on, who used to be on the show a lot. He's over at Chi-X now, very much in the news over there, being acquired by the Chinese. A conversation for another day. But he mentioned some data someone at the CBOE just told him, which we all kind of thought was interesting. Now, if you had to guess yourself, Dan, what would be, you talked about covered calls and stuff, what would be and you mentioned iron condors too, what would be, in your mind, the number one premium income generating use case for options? What strategy you think is the number one way people like to generate income with options?
Man, I'm just a freaking broken record today, because once again, my answer is different than what I think the number one way, the most used one, because, the right answer for this is it depends, you need to do a volatility analysis. If volatility,
I'm not saying the most effective. I mean, just the one most people use, and volume-wise.
Volume-wise. Yeah, okay. That's what I thought the question was. Statistically, I guess I'd probably say it's credit spreads, just because they're simpler than things like iron condors. People really love to talk about iron condors, but I think people like to keep things simple, just in life and in option trading, and I encourage that. Keep things as simple as possible. So I'd imagine probably credit spreads.
It's interesting. My first blush at that would be covered calls. That's kind of just the use case everyone has. And then maybe the other side of that, of course, being the short puts, one of those two. But according to the guy, again, I don't have the data to back this up, but he said the guy was a reliable source. It is iron condors. They've done some new data, and iron condors are apparently. I definitely want to see the data on this, because I don't know if I fully buy that. Yeah. But that surprised me. If you had told me that maybe 4 or 5 years ago when iron condors were super hot, maybe I would have believed it. But I don't know. I just found that interesting when you mentioned the income and the iron condors. It kind of just jumped out to me. So there we go.
And actually, when you said covered calls, that really would be my answer if I thought about it a little bit more.
Dan's backpedaling now.
Yeah.
The live mics listeners, they're putting him in the hot seat. You can see him. He's sweating profusely. He's got a single tear in his eye. He's like, "Why are you doing this to me?" All right, let's wrap up with a couple more here, listeners, and we'll get Dan off the hot seat. This one comes from. Let me see if I can scroll it back up for you here, Dan, so you can play along as well. There we go. This one comes from Trader's Son, however you want to pronounce that. He writes, this kind of goes back to what you were saying before the top of the show, Dan. Can a trader make a decent living buying straight calls and puts? Or do you have to get crazy? Oh, this is very timely. Crazy with the complex stuff like iron condors. So we were just talking iron. This is right up your alley. Go for it, Dan.
Yeah, I think straight buying calls and puts is a really hard way to make money, because every single trade you're making, you have time decay working against you. Not that buying calls and puts and enduring time decay is always a bad thing, but I don't see the words implied volatility anywhere in your question here. And so, in periods where implied volatility is overpriced, and there's tons of data that suggests that in general, long-term overall, implied volatility tends to be overpriced. It's not always, but it tends to be, statistically average, law of averages here, overpriced. That means that option selling strategies tend to work better in the long run. Again, not always. So you would only want to be buying straight calls and puts when there's one of two things. One is when implied volatility is underpriced, and B, when you're looking for a really very big move. If you're looking for a pretty small move, you're going to way outperform doing a debit spread than buying a call. And, you kind of finish this with or do you have to get crazy with complex stuff like iron condors? Keep it as simple as possible. I mean, you don't have to get very complex, especially if you're a newer trader, but moving on to credit spreads, just for a starter, which is not terribly more complex than just buying a call, I mean, there's two options instead of one, but, it's not really that complicated. That opens your door up to so many more possibilities and gives you the ability to be a little bit more sophisticated, and you will have better results when you add that to your arsenal.
Kind of ironic, Dan, that the first trade a lot of newcomers to the options world make is one of the hardest ones to make money on. They come in, they just straight up buy a call, or sometimes 8 to 10% maybe buy a put because they can handle the kind of inverse relationship there. But 90% of them buy a call. And as we just said, that's kind of one of the hardest ways to just straight up make money time and again. You got time decay working for you. You need to have that, like we said before, that catalyst. Something's got to happen to really make that pay off in a short term. It's got to happen within the time frame that you purchase. Otherwise, it could be if you buy the 1 month option and it happens at 33 days, guess what? You're out of luck. So all those factors are weighing against you. And that's always how they start. And then they have a bad experience 9 times out of 10. They're like, oh, I washed my hands of options. These things are terrible. So yeah, you kind of wish, and maybe listen to a show like this, they do this where, they come in and they kind of get the next nuanced leg. They do the vertical instead of the straight up call buy or something. You're right. You don't have to go crazy iron condors, 4-leg, 3-leg spreads. You don't need to do that. But even a simple vertical 9 times out of 10 is going to be a heck of a lot better than just buying that straight up call. At least you have some decay working for you in that balance, which is a nice thing. So yeah, you can do it, but you're right, Dan. That is one of the hardest roads to hoe. I mean, remember when we were market makers, long premium was always a battle. What'd you have to do to make that make money? You had to scalp gamma aggressively in order to do that. And retail doesn't really have that weapon in their arsenal for the margin requirements, for a lot of the underlying work that takes the extra capital you have to leave sitting around free in your account to buy and sell stock all day. It's just not a reasonable thing to expect a guy with a $25,000, let's say, retail account to do. So you're taking away the one thing that we as pros used to do to be able to defend ourselves with the long premium. If you don't have that, and what the hell would you have done on the floor? I would have been hard. You have to spread out of that every time. That's not always an option. You can't always be, neutral on that stuff as much as you want to be. You're going to have some residual vega or premium there somewhere. So yeah, that's why we say it's a rough road to hoe, particularly for retail. Great questions, everybody. I want to take my cap to everyone who tuned in live as well. We're going to do this on a more regular basis, bring Mr. P here into the hot seat and do it live. Great questions live. Like I said to everybody else, if you're listening live and for whatever reason you don't have a Mixler account, you don't want to set one up, you can still hit us up the old-fashioned way, questions at theoptionsinsider.com or twitter.com/options, probably a good one. Also on Facebook and the other places, stock twits as well. We'll be monitoring those throughout the show, and if you have questions, we'll kind of route them on as well. We love to hear from you guys. If you are listening live, tune in again at 3 p.m. Central here today, where we'll be doing our option block program live. I believe we're on episode 502 there, Dan. It's crazy. Mind-blowing. But before we wrap up here, let's check back in with, he's actually not wearing his black hat today, listeners. I'm a little bit disappointed. But we'll check back in with the black-hatted one. Mr. P, what is cooking in the land of market taker mentoring, sir?
Oh, I think I might have mentioned this in the last show. We are gearing up and creating our classes for and doing a lot of planning for our annual options trading retreat, which is this year in Telluride, Colorado, July 22nd and 23rd. This, for those of you who aren't familiar with this is a big deal. We have about 30 traders of our students. We still have room for a handful more, so there is still room for this. You can join us in Telluride, Colorado, June 22nd and 23rd. It's 2 solid days of education with me, John Komisik, who's our other coach. You meet the whole market taker team, and then following that, we have a dinner reception where we have some cocktails. We have a really nice dinner, watch the sunset over the Rockies on a Florida ceiling big window. It's fantastic. It's a fabulous room. Was just checking it out there a couple of months ago at sunset. It's amazing. Bring the spouse, girlfriend along. Don't bring both. It's a really great time. You can go on over to markettaker.com/telluride, markettaker.com/telluride. And as long as we still have slots open, please consider joining us. You'll love it.
All right, listener, surf on over to markettaker.com/telluride, 2 L's in Telluride, correct?
Yes, sir.
There we go. So if you can't spell it, there you go, listeners, to check it out for yourself and reserve your seat before they're gone. I'm still waiting, Dan, for my first class invitation, complete with extra bonus sunset package. I'll be looking for that in the mail forthwith. In the meantime, listeners, you guys can surf over there to Dan's site and reserve your own seat, and maybe he'll see you out there in Colorado. And on behalf of Dan and indeed myself, I want to thank all of you out there in the listening audience. You guys are the reason we do this show. Without your questions and fun insight like that, we couldn't answer them. So we love those. Keep those questions coming via all the platforms I mentioned before, as well as the live stuff. We'd love to have you tune in. Keep an eye on our Twitter and our Facebook for the links we're going to broadcast out when we do live shows. Obviously, boot camp still kind of fluid in terms of when we do it live. It's whenever Dan and I kind of have the time in our schedules. In terms of the regular shows we do live, right now it's going to be Option Block on Mondays and Thursdays, 3 p.m. Central, 4 p.m. Eastern, and Volatility Views at noon Central, 1 p.m. Eastern on Friday. So keep those bookmarked there and keep that Mixler. It's the same link, the same Mixler link every time, that same page. So if you're going to keep using it, bookmark it. Sign up for a Mixler account. It's free, and then you can ask questions live right through the chat. It's pretty fun stuff. And on behalf of Dan and indeed myself, I want to thank all of you out there in the listening audience for downloading, streaming, subscribing, all the fun stuff you do, including asking questions. And we'll see you next time right here on Options Bootcamp.
Options Bootcamp is produced by the Options Insider, Inc. All rights reserved.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.